recommendation slip. And so we have your goals outlined here. And we want to start with establishing a budget and managing accounts. Then we go into a timeline of buying a house. Then we're going to go more into long-term effects such as retirement and investing. And we're going to go into your vehicles because they are a cost. And we're going to look at the type of vehicles you get. And then we also want to clean up all your debt. And let's start. Your current finances. We have your housing debt, transportation, insurance, and other types of debt. And you have an income which is higher than this current debt, which is good because you are making around $2,000 still in, as a net profit. And yeah.
Okay, so for housing, this is definitely a big priority for you guys. And we started looking into houses that might fit your budget. So it was mentioned that somebody's parents could help match for the down payment. So this is a really good opportunity to start, obviously the opportunity to save. So the down payment typically could be like 20% of the cost. So if you want to get a house like this with 2 beds, 1 bath and yard, the down payment would be roughly $48,000. So we need like $14,000 more saved so that the parents can match it to get to that down payment. And the actual like cost per month on a house wouldn't be like any more than your rent that you're already paying, so it's not that bad at all. And the mortgage payments overall, the way we calculate that basically, should not be more than 28% of your income overall. So at a maximum, it would be like $2,400 per month, but this shouldn't be a problem at all for a house of this size.
So going over your debt, which is a major part of your short-term plans, and was a major concern of yours. So one way that you can heavily reduce the amount that you're paying monthly and overall for your public student loans is applying for IBR, which would lower your monthly payments to only $270 for both public student loans, because it does it based off your dysentery income, which is your income subtracted by 225% of the poverty line for your family size. So not only would this lower the amount, but since you're having a child soon and you will have a family of 3, the wife will not have to pay anything since she's under that amount. And this makes it so financing separately is much smarter, because if you finance together, it will take it out of the total household income. But if you do it separately, then the wife's income is null because she's under that 225%. And there's taxable forgiveness. So if it's still taxing over after 20 years, all of that will be forgiven. But there's no interest shield, so you will be gaining interest overall this time. And then once it finishes, then the interest that you accumulate will be, all the forgiveness will be taken as income, which will be put you in a higher tax bracket, which will hurt you. But you can apply for the SAFE plan starting September 2025, since it's currently paused, which would also similarly lower your payment costs monthly. Instead of 10% of your income above the dysentery income, it would be only 5%, which would once again reduce your cost to only $120 for both public student loans. And once again, you want to do this separately, and this would save you like $400, because before you were paying around $570 monthly for the minimum cost of these. Now you're only paying $120 for both, and anything that you don't pay after 20 years is fully canceled, and you don't have to pay anything. And for credit card debt, there you have some options. You can consolidate the credit card debt under a balance transfer card. So all the debt would go to a single card with a hopefully lower interest rate, with an initial fee of only $203. So this would be easier for you guys, since you would only have to do it to one payment, and it would have no interest, hopefully, for like for a different amounts for around 18 and 21 months, which would also reduce the amounts. But it does hurt your credit score by about 5 to 10 points in the short term, which could hurt your chances of buying the house that you want. However, this is only within the first 6-ish months and will quickly bounce back. Another method you can do is avalanche or snowball payment methods. The avalanche method is to pay off the debt with the highest interest first, to reduce the amount that you're paying in interest over time to save the most money long term. The snowball method would be paying off the smallest amounts first, which gives you a sense of accomplishment, helps you kind of get that ball rolling, and it makes it easier to go through with it.
Alright, so let's go into the investments. So we want to talk about the 401k and Roth IRA. So these are two different types of retirement funds. And the 401k is basically where you pay the tax, or you pay the tax after you move them on at 59 and a half years. And so we want to put about where your employer matches, because what 401ks give is they give an employer match. And here they're giving $2,500. So you want to achieve that by putting about $500 per month. And you don't want to leave this money. So the Roth IRA is another way of doing it. The Roth IRA basically is where you put the money in, and then you get taxed immediately, so you don't get taxed later on. And basically, if you get bigger returns, it's beneficial to for you guys to get a higher return, especially if you have more money at the end. And it's also more the max limit here is about $7,000. And once you finish adding to your 401k, it should be a good idea to add to your Roth IRA. So let's get into some specifics. So you want to invest into different types of funds. So on the right here we have different types of mutual funds and ETFs that you can invest in, such as the S&P 500, the 12 market index, and the NASDAQ. And I would recommend more growth focus since you are in your 20s. And it is important for you guys to invest for long term, because you're not going to retire next 5 to 10 years. So the S&P 500 has returned about 10% annual, and has consistently done this for the last around 100 years. And if you put this into investment capital, as we have shown here, with the starting amount that you have in your Roth IRA, which is currently $6,575, after 30 years, which is basically which are around 57, when you guys are around 57 years old, your retirement age, with 10% return that we've seen before, you should, and then additional $500 that you'll be putting into your retirement accounts, you should be ending up with a balance of $1.15 million. So, and I want to show you the impact of these investments and how much money that you can do. And just $200 can make a massive impact. As you can see here, with doing $300 a month for these 30 years, you'd be achieving only, or you'd be getting only $738,000, and on the other side, you'd be getting with $500 a month, you'd be making $1.15 million, and there's only about $72,000 difference in the amount that you contribute. So, and then we have the college fund. So this is for your children. This is for a more not a long-term way to look at this. And it's important to start adding to your 5 to 29, as this can be used towards education, and there's many tax benefits to this. And so these earnings are usually not subject to any state or federal tax. And you can, any of the mom or dad can contribute to this.
All right, so now we're on the transportation options for Olivia. All right, so for Olivia, once your lease ends, you can either release it, or you can save up to buy a more cheaper, used, or reliable car. As shown below, like the 2014 Mazda 3, which has really, really good gas mileage and is a pretty relatively low price. You can find others from Edmunds.com to find more reliable cars. But for you to do that, you would, if you were not to release your car, but to save up for the used car, then you would have to save up for about 12 months. And if you keep saving about $454, the same amount that you paid for your lease, for about 12 months, you would accumulate about $5,500, which would be enough to get any reliable or cheap car. And however, while you're doing that, you would need to be carpooling, where you need to ask Marcus or other people to carpool with, or you could invest in a bicycle or any other form of transportation. However, if you are more of a car person, then you would have to carpool with other people. And as for you, Marcus, you see, you still have your loan to pay for your car, and so once you pay off that loan, we're thinking of having you buy a cheaper and more reliable car like Olivia, where your insurance will go down drastically compared to the original car that you have, and you have around about like 1,200 equity available for things like car repairs or just maintenance. Like another example would be like the 2015 Chevrolet. And so for the car insurance, there are three things you can do to reduce your premiums. One thing you can do is to apply for a multi-card discount. Since Marcus is a part of the Allstate program and Olivia is part of Liberty Mutual, you can have both of them be on the same policy, the same insurer, so that they're eligible for up to 10% discount on each of their cars. Additionally, they can also raise their deductibles, which will lower their premiums. However, there's an issue with this. There's a big risk, because if you do get into a car accident, then you would have to pay a much higher deductible. And if you just so happen to be a safe and proper driver, you could also apply for the insurance relief programs such as Liberty Mutual's Right Track, which will give you up to a 30% discount so long as you drive safely and properly and you abide by the traffic.
So we also noticed that Marcus was eligible for the health savings account, and he had some questions about that. So in the health savings account, the money, you don't actually lose it. It does roll over year after year, and it does grow tax-free, and you are eligible for it because of your high deductible plan, and we have a resource there for learning more about that. It's not an immediate priority, but it could be useful.
So we have an emergency fund here, and so it's important to have an emergency fund, as it could basically be a source of, so in case of emergency or like some accident or some other life issues that you can face, if we spend about, if both parents work, you guys can in 3 months save for a good emergency fund, and you can do it in 6 months only if one person is working. You can do separate accounts here, and the house fund is an emergency fund currently, but we want to kind of spread this out, diversify it as a long-term goal.
Okay, so we also have some kind of more difficult lifestyle changes that could help you save some more money month to month to better meet your financial goals. So we did notice that Marcus had a fitness membership, and since Olivia is getting it for free from her gym, she could see if Marcus could use the facilities also. And we're also suggesting narrowing down some of your streaming services. So you could get Prime Music with your Amazon Prime subscription, and then cancel the other subscriptions for the Apple Music and the other things, and then just watch Amazon Prime. And you could save like $40 a month by doing this, and maybe also reducing the sports betting to better meet your financial priorities, at least short term for the near future. And also those buy now pay later purchases. It's important to make sure that they're fitting within your budget, so that way when the bills come even more, you know that you can manage them. Some other things, we also noticed that Marcus was taking a weight loss medication, and that you guys were also eating out 8 times a week. So we suggest narrowing that down to 1 day a week eating out, and by cooking at home, you can more easily track the foods you're eating, and this can help maintain a healthy weight, and then you can slowly, maybe within 6 months, get off that medication. That can save you a lot of money monthly for the house, for the investments. Yeah, and this eating out only 1 day a week could save you $370 monthly.
So we have some side hustles here, and there's multiple different side hustles you can do to achieve more money, and you can become such as like you can do some sporting for some maybe perhaps some little leagues, or you can do something like Uber once you have free time. You can also do multiple other things, as this is a very diverse type of thing to do. You can do such as taking care of pets or mowing the lawn, and approximately you'd be making about $50 an hour. So the income tax here is so with expected return of $2,850. In Michigan, we have the interest rate, income tax rate of 4.25%, and you'd be eligible for another tax credit with a child of about $2,000.
And we kind of just laid out like your priorities kind of in order, and also the money you can save by making some of those lifestyle changes. So this number would be hopefully what you guys could like save overall to start putting towards the investments, the retirement, stuff like that. But your very, very immediate short-term goal should be paying off that credit card debt, because the interest rate is so high.
Thank
You got it. Good. Yeah, so I know I was talking to my dad before we went into this, and he said with the kid comment,
I should make sure I ask you guys about life insurance. I don't know if I saw that on there. Is that something that we should apply for? Is that something that we need? How do we know how much we need?
Yeah, through your work, you had a 50%, I think it was salary life insurance, and definitely with a family your size, definitely a starting family, it's very important to have life insurance. And I think the plan we're looking at was $15 a month.
So I can get a policy for $15 a month, you're saying? Do you know how much the insurance that would provide me?
Your work would match 50% of your salary. I don't.
Okay. Great.
You talked about changing cars. Are those cars really old? And are they safe? And what if I have a lot of repairs where, you know, I feel really comfortable just having it in my car now because it's new? And with a child, I'm just really concerned. You said there'd be a really big risk if we raise the deductible, but what would be the amount of the risk?
So the risk would mainly be in whenever you get into an accident where you would need to use your insurance. The only risk would be the raising of the deductible, the price you have to pay. And as for the used car, like you mentioned, I would honestly say like she could still release the car so long as she can still keep paying the lease. And one thing that she could do is instead of like doing that full lease for 36 months, she can maybe save for 36 months and gather about $15,000.
There's a buyout cost on the. So can I just finance the buyout on the car?
You probably get a discount from the dealership for doing that, but this is just a way if you need to save more money per month, this is an option.
Yeah, this is because these cars are more reliable. They have more efficient fuel usage. They have they're more reliable cars that you could use, especially if you have a child. And so, of course, you need to look at the safety, but you also need to consider other factors such as the gas mileage, price.
I won't be going as many places.
Yeah. One last question. When you were talking about student loans, you said something about we had to finance separately. Can you explain a little bit more what that means?
So instead of jointly and doing it together in one collective one where you would pilot your total house income for one line, you would instead both do it separately. So maybe telling your father, well, like you could apply for that and have him do that if he would be more knowledgeable, or you could go and look into a like financial like manager, like a nonprofit one that could be free, that could help you not only for just financing separately and helping you get through applying for these things, the IBR and the SAFE plan, but also just help you in the future for any like financial things you might be looking into or need help with. So just looking into getting help from that. But yeah, just.
If we finance separately, would we have to file taxes separately to split our income?
I do not. I think you might have to file taxes separately, but
I think it's more about the account where the payment would be made from.
I'm sorry, what's that?
I think it would be more about the account where you're making payment from for the debt rather than filing taxes. It would just be more about the taxes look at like your household income, and then this would be more about like the actual account where the money is.
and also side note that I just want to say is that also since that it was paused for this while, there might rise some concerns of if like, oh, what if it gets canceled at some point in the future? Like, what if it's not available? With this money that you're saving from not paying this, you could also put that into your like set aside money, such as the emergency fund. So if at some point policies change, then you still can have that peace of mind knowing that you have money to pay off a lot of this. And also, once again, having an emergency fund is just very crucial, and that we can use that $10,000 that we do have in the down payment, that being able to use that for as part of our emergency fund. Since the baby on the way, there could be a lot of complications. If anything like red happens with the baby, if it comes out at birth, complications, then just having that extra money could be crucial for this family. So obviously, that'd be really important.
Okay.
I'm good, you guys. Thanks for your presentation. We appreciate it. On all the knowledge.